Rahul Singh, CIO for Equities at Tata Mutual Fund Johnson, to explain that. Rahul, good having you. Thanks much for joining in. Neeraj here. Good morning. It's not just about today's move, but the last few sessions, India is kind of decoupled from the global optimism. Is it due to these idiosyncratic factors, and do you reckon that they are so sharp that they could continue to put the Indian benchmarks under pressure for the foreseeable future?
No, I think it's too short-term a trend to kind of draw, long-term conclusions from. But basically, I think if you look at the last couple of days or last week or so, there's been some optimism about trade war getting resolved, or at least some progress in the trade war talks. And that obviously does not help India in the way it helps other emerging markets. So to that extent, I think, if the continued trade war tensions continue, and if the global slowdown continues, gradually it benefits India. But if there is a feeling in the market that the trade war is going to progress and get resolved at some point of time, which I frankly have my doubts on, then obviously the focus will shift to other emerging markets which have underperformed India over the last couple of months. So I think it's the market is in that kind of a flux. It's very difficult to kind of, as I said, draw conclusions from what is essentially last couple of days trend.
Sure. Rahul, good morning. This is Agam. So based on what you have suggested right now, if the overhang could continue for much longer than what is being expected, that also means, well, uncertainty with respect to fund flows. And again, that's something that has, well, to a certain extent dried up over the past, well, I would say 2 months. Do you think that could likely be the case going forward as well? Because the fact that a lot of these institutions prefer just the top names, in fact, even in the Nifty 50, just the top 10 odd names. Do you think that strength could possibly only remain in those stocks, whereas the broader markets continue to suffer?
Well, a couple of things here. I think you're right in the sense that the focus would tend to be towards large cap and large and mid cap. But already this year, if you look at two things I would like to highlight. One, within the large cap, the leadership has changed hands, barring a couple of banks which were doing well last year, which continue to do well this year as well. The focus has definitely shifted to corporate bank. The focus has shifted a little bit to the value stocks, whether you look at the power utilities, is a case in point. The focus has also shifted to some of the laggards which were there last year. So, you would see some of the sectors which did very badly last year have begun to at least participate in the market along with the rest of the large cap. So even within the large cap, the leadership seems to be changing, and it's not so subtle shift. It's quite an obvious shift if you look at first 6 months performance of this year. The leaders, even within Nifty, would look very, very different from what they looked the entire 2018. So that, I think, is a very important trend to watch out for. Secondly, I think the mid cap, small cap are now keeping pace. I mean, if you look at the index levels, I think the indices are just about keeping pace with the large cap, headline indices. And I think that's the beginning. I mean, that's just the beginning for, probably 6 months later for the mid-cap, small caps to start doing better. So our view remains that the market will become broad-based. It's very difficult to say whether it will happen in 3 months or 6 months. But we can see that the early signs are there of the leadership being very different within the large cap, and even within mid-cap, small cap, we are seeing that the indices are not as hugely underperforming as they were last year. In fact, some of the indices are keeping pace with the large cap indices.
Okay, Rahul, the choice seems to be, I mean, at least the most candid conversations that are happening in the last few days have people who are CIOs of different AMCs or portfolio managers talking about two sectors most vociferously. One is autos, where the belief is that maybe the pain is in the price. Two is information technology, where the belief is that it's a bit of a defensive, and if the currency doesn't appreciate too much, there are gains for the taking because the growth seems to be certain there. What are your thoughts on both of these pockets?
I would agree with IT services. It's like a hedge right now. If the economic growth does not pick up in India, and if the domestic cyclical sectors don't do as well, and if this NBFC crisis becomes a systemic crisis, then currency will probably depreciate instead of appreciating. So to that extent, it's a good hedge to have in your portfolio. As you said, the companies are going to deliver high single-digit growth. With maybe not margin expansion, but at least that is in the bag, with companies being cash rich, with buybacks and capital return, which is there in this sector. I think there is an inherent support to the valuations in this sector, which are at the higher end of their historical range, but not terribly expensive as of now. On the other hand, autos, if you look at, it's running into a bit of headwinds in terms of the various transitions which are happening in terms of safety and environmental regulations. So the cost of ownership issues are going to be there. The inventory issues of running down the old inventory and building up the BS6 inventory, those issues are also there. So it's a sector where one would need to be very, very selective. Probably one could look at two-wheeler stocks where the valuations are even more reasonable. And we are probably coming to an end of a hyper competitive phase, so you could see some recovery there. But barring that, it's a sector which is right now in a wait and watch kind of a mode, as and when the cyclical recovery happens in demand, which looks like there are more headwinds than tailwinds for that going into the next 6 months.
Rahul, it's becoming a tad hard to find ideas in such markets where there is a lot of uncertainty. But my question is, what are those factors that you are watching out for in the markets, at least in the broader markets, perhaps in the mid-cap and the small-cap names, that you would keep in mind that would make it easier for you to weed through the noise and perhaps allocate some amount of resources towards these names?
Well, I think our investment philosophy at Tata Mutual Fund has been to look for ideas where we believe the earning upgrade cycle is going to take place over the next year or 2 years. So corporate banks is one such sector where we continue to believe that there is potentially positive surprises still left, although it's become a consensus trade. Similarly, I think parts of capital goods are looking good in terms of just the way some of the companies have changed their business model from being power dominated to now dominated by other segments of the capital expenditure cycle, and we are seeing some green shoots of that. So essentially, one has to identify ideas, companies, sectors where we think that the earning expectations are moderate, and we are actually running into a period when there could be earning upgrades rather than downgrades. And that barometer one has to apply the other way around also, in terms of what are the sectors where the earning expectations are at its peak, and then you could actually get disappointments. And that's a simple kind of process one can have in a time like this to make sure that you keep generating alpha over and above the market, whatever the market does.
Also, the other aspect with respect to consumption, Rahul, is the fact that while the economic indicators are showing some amount of slowdown, that really hasn't shown up as much when it comes to the top line names like perhaps an ITC or an HUL. I understand you can't talk about stocks, but would you like to stay with these names and perhaps I'm talking about the big FMCG companies, and perhaps even increase allocation towards these names?
See, most of the companies in the FMCG space, barring a couple, have demonstrated that or have told us that there is going to be a period when you could have rural slowdown impacting their top line, and they have been very, very clear and categorical on that. So when you are running into a situation like that, and with the valuations where they are, committing incremental capital becomes difficult in this sector. Having said that, it's still a sector where the quality of the company is high, quality of cash flows is good. So it's a sector which will always remain in favor from a long-term perspective. But from a short-term perspective, it's becoming difficult to identify stocks which have any potential left for an upside surprise. Most of the cases we think that there could be downside surprise, and therefore incremental capital allocation in this sector becomes difficult. Again, as I said, it's difficult to paint the entire sector with one brush. There are companies which are executing superbly and still managing to surprise positively on the discretionary as well as on the staple side. So one will have to stay with those bottom-up companies which have bottom-up driver of earnings, rather than trying to take a sector call.
Okay, Rahul, always a pleasure having you. Thank you so much for taking the time out today and speaking to us. Really appreciate your time.
Thank you.
Well, the markets are still languishing, well, not correcting too much, but about 0.25% lower in the context of what the rest of the Asian markets are doing. Yes, these are certainly languishing. I'll take a break on that note. On the other side, we speak